Hello and welcome to another session of the My Solo 401k Financial Daily Webinar Series. We're excited today to discuss the $72,000 Fidelity Roth IRA hack for 2026, which is via the Mega Backdoor Roth Solo 401k. If you have questions or topics you wish to discuss, please chat that over now so that we can be sure to get to them all. This presentation, of course, is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. Again, welcome to another session of the My Solo 401k Financials Daily Solo 401k webinar and Q&A session. This is our second session of the day. We welcome the opportunity to discuss these topics to help you ultimately stop overpaying taxes and start building real retirement wealth. Again, this is your chance to get answers. Please use the chat to ask questions on today's topic or anything else. So while you're chatting up your questions, let's dive into the slides. We also want to remind you to subscribe, really invite you to subscribe to our channels, whether you're watching us on YouTube or LinkedIn or X or Instagram. We've got a wealth of information. We're live here every day, bringing content, answering questions, and we're going to have some really great deep dive sessions coming up. So please subscribe so you can get the notifications. You can watch live or you can come back later and watch the recording. For example, really deep diving contribution topics like how much income that's needed to maximize contributions, Mega Backdoor Roth Solo 401k deep dive guides where we go through scenarios, and it's really customized for all the different business types, whether it's an S corp or a sole prop or a partnership. So please subscribe. So now let's turn to, again, the $72,000 Fidelity Roth IRA hack for 2026. Mega Backdoor Roth Solo 401k is the vehicle that you can make this $72,000 Fidelity Roth IRA contribution. So of course, many people understand that there are contribution limits that apply to a Roth IRA, but there are ways to hack that. There are ways to contribute even more than the $7,500 Roth IRA contribution limit that applies for 2026. So one of the most powerful ways would be the Mega Backdoor Roth. So you may have heard of the Backdoor Roth IRA contribution strategy. Well, this is going to be almost 10 times that via the Mega Backdoor Roth Solo 401k strategy. So in order to have access, though, to this strategy, you have to have a solo 401k, number one. So that means that you have to be eligible to set up a solo 401k. In order to be eligible to set up a solo 401k, in short, you've got to be self-employed with no non-owner, non-spouse, full-time W-2 employees. That's what allows you to set up a solo 401k generally. Then you'd have to set up a solo 401k like the one offered by my Solo 401k Financial that allows you to make Mega Backdoor Roth Solo 401k contributions. So with the Mega Backdoor Roth Solo 401k contribution strategy, you can contribute up to $72,000 for 2026, as long as you've got the self-employment income to justify it. And then you could transfer that voluntary after-tax solo 401k contribution of $72,000 to a Roth IRA. It could be a new Roth IRA, an existing Roth IRA. And then those funds will be in your Roth IRA, where just like any funds in the Roth IRA, they're going to have that potential for tax-free growth. So in short, that's the hack. You set up a solo 401k, assuming you're eligible, specifically one that allows for Mega Backdoor Roth Solo 401k contributions. You make a $72,000 after-tax contribution to the solo 401k, then you transfer it to a Roth IRA. So that's the hack. Now let's dig into it a little bit deeper to really understand it more deeply. So again, the foundation is setting up a solo 401k. So you got to qualify to set up a solo 401k, meaning that you're self-employed with no full-time, non-owner, non-spouse W-2 employees. Then you need to set up a solo 401k like the one offered by my Solo 401k Financial through a provider that allows for those mega backdoor Roth solo 401k contributions. So it's not going to be just the vanilla basic solo 401k that you get off the shelf from, say, Fidelity or Schwab. You can have your accounts at Fidelity and Schwab, but you've got to first get the advanced plan, like the one offered by my solo 401k financials. So when we say a plan that allows for mega backdoor Roth solo 401k contributions, that really means that the plan allows for two steps. It allows for voluntary after-tax contributions, because that's the first step, and then an in-service distribution or transfer from the voluntary after-tax solo 401k account either to a Roth solo 401k or a Roth IRA. And that's how the funds would end up in a Fidelity Roth IRA. So you'll, of course, want to work with a provider that has deep experience in helping customers with these mega backdoor Roth solo 401k strategies. And no provider has more experience than my solo 401k financial, because we were the first provider to offer a plan that supports the mega backdoor Roth solo 401k contributions. So we've got deep experience in answering questions, helping clients through the technical steps, as well as providing the ongoing compliance support. So when you make a mega backdoor Roth solo 401k contribution, it's really two steps. That's why both steps have to be supported by the documents. First step is you make a voluntary after-tax contribution. So that step is not reportable. It's not reportable on the business return, the personal return. It's not reported on your W-2, for example, if your business is taxed as an S corp. But the second step, when you transfer the voluntary after-tax solo 401k funds either to a Roth solo 401k or a Roth IRA, that does need to be reported. It needs to be reported on a Form 1099-R. And we handle that Form 1099-R reporting for our clients for no additional charge. Our clients or their advisors just have to let us know about that after-tax to Roth transfer by submitting a form on our website. That's how we capture the information we need to be able to prepare the 1099-R, again, which we do for no additional charge. Now, this time of year, one of the top questions is going to be, okay, when is the deadline to make these contributions? Can I still make contributions for 2025? The answer is yes. So if we're talking about a $72,000 Fidelity Roth IRA hack, now we understand that the vehicle to make that $72,000 Fidelity Roth IRA contribution is via a mega backdoor Roth. And we understand that when we say mega backdoor Roth, we're really talking about making a voluntary after-tax contribution. So as we sit here in the, at the beginning of 2026, here in February 2026, it's still possible to even set up a new solo 401k plan in 2026 and make voluntary after-tax contributions for 2025. So that's the late start reality check. So many people sign up for a plan, during the year for which they may want to make the contributions. And the rules are more flexible for solopreneurs. So as long as someone signs up by the end of the year, they preserve the ability to make all types of contributions for that year by that year's business tax return deadline, including any timely filed extension. So stated differently, everybody that's set up a solo 401k, whether with my solo 401k financial or with another company on or before December 31st of 2025, those individuals would have preserved the ability to make all types of contributions for 2025, whether employee, employer, or voluntary after-tax contributions by their business tax return deadline, including any timely filed extension in 2026. But even if you didn't set up a plan by the end of last year, you can still set up a new plan in 2026 and at least make voluntary after-tax contributions. So regardless of how your business is taxed. Now, if your business is taxed as a sole proprietorship, could be a single member LLC, taxed as a disregarded entity, so it's taxed as a sole proprietorship, or just somebody that doesn't have a formal legal entity, you could actually still set up a solo 401k and make all types of contributions, even employee, employer, and voluntary after tax. You'd have to make those employee contributions by April 15th, 2026, if you're a sole prop. But even if you're not a sole prop, let's say you're an S corp or a C corp or a partnership, if you did not set up a solo 401k by the end of 2025, and now you're setting up a solo 401k here in 2026, it's too late to make employee contributions, but you could still make both employer and voluntary after-tax contributions. And as we learned, how you make the $72,000 Fidelity Roth IRA hack contribution would be making a voluntary after-tax contribution for 2025. So you could still make voluntary after-tax contributions for 2025. Now, the 2025 contribution limit, the overall limit that applies to those voluntary after-tax contributions is $70,000. So it's not the full 72. 72 is the limit for 2026, but you could still get a large amount in there for 2025 if you've got the self-employment income to justify it. So if you didn't set up a plan by the end of last year, you could still set up a plan now. You can contribute 100% of your compensation, your self-employment compensation for 2025, dollar for dollar, all the way up to the 2025 limit, which is 70,000. You would have to make that voluntary after-tax contribution by your business tax return deadline, including any timely filed extension. And then there's no deadline to then move the money to a Roth account. You can either move it to a Roth solo 401k or a Roth IRA. Now, most folks will want to move it right away. So now they can get the money into that Roth account and start investing and start accumulating gains that'll have that tax-free growth potential. So the critical deadlines, of course, is your business tax return deadline. So it's not necessarily April 15th, right? If your business is taxed as an S Corp, it's going to be March 16th, since the 15th falls on a Sunday, or September 15th of 2026, if you file a timely extension for your S Corporation return. So the math would be for 2025, you can contribute 100% dollar for dollar up to 70,000 as a voluntary after tax. So you could skip employee, right? If your business is an S Corp, it's too late to set up a new plan for 2025 and make employee contributions, but you don't need to make them in order to execute this strategy. You could skip employee, you could skip employer, you could just make 100% voluntary after-tax contributions, dollar for dollar of your self-employment compensation. So it's 100% dollar for dollar, all the way up to the overall limit. And then transfer those funds to a Roth account so that it has that tax-free growth potential. Now, for 2026, of course, you've got plenty of time. So you could still set up a plan anytime here in 2026. As long as you sign up with my solo 401k financial in 2026, you'll lock in the ability to make all types of contributions for 2026. So employee, employer, as well as voluntary after tax. So of course, our plan allows for pre-tax contributions. So some individuals, they want to diversify from a tax perspective. They might want to first max out their pre-tax contributions, first fill up that employee bucket, that employer bucket with pre-tax contributions, and then do whatever's left up to 72,000, assuming they've got the self-employment income to justify it, as a voluntary after-tax contribution, then transfer those voluntary after-tax solo 401k funds to a Roth account so they can grow that tax-free growth potential. But others, they're just focused on making Roth or mega backdoor Roth contributions. So the simplest thing to do would just be to make 100% voluntary after-tax contributions. And then the great thing about that is that voluntary after-tax contributions are not reduced by contributions that are made to a day job plan. So you might have a side hustler who's got a W-2 day job that might be maxing out their contributions to their W-2 day job 401k plan. That's not going to prevent them from also hitting the $72,000 voluntary after-tax contribution limit based on their earned self-employment compensation. So in other words, that voluntary after-tax contribution limit applies at the plan level. It's not reduced by contributions made to another plan like a day job 401k plan, with the only exception being if that's a 403b, in which case those 403b contributions, whether they're employee or employer, those contributions together with any contributions that the individual would want to make to the solo 401k, the sum cannot exceed the overall limit, which for 2026 is $72,000. So that's how you would get $72,000 into your Fidelity Roth IRA, right? Almost 10 times the Roth IRA contribution limit. So now, what are the steps? Let's again review the steps. So of course, number one, you got to be eligible. Number two, you got to set up a solo 401k plan like the one offered by my solo 401k financial that allows you to make mega backdoor Roth contributions. Then you'll need to open up an account. Now we are focused on providing the plan compliance support. In other words, we don't hold or have access to our customers' funds. we're totally neutral as far as where the accounts are opened up at. So Fidelity, that's the top brokerage option. There's a lot of other good options as well. Schwab, for example, customers are also opening up accounts at hundreds of different banks and credit unions. So we're very hands-on in helping customers open up accounts at the bank or brokerage of choice. But let's assume you want to have the account at Fidelity. And if ultimately the money's going to end up in a Fidelity Roth IRA, then that's going to make it easy, of course, to transfer the funds from the brokerage account at Fidelity for those voluntary after-tax solo 401k contributions over to your Roth IRA. So we'll help you open up that free brokerage account. So Fidelity doesn't charge anything to set it up. There's no maintenance fee for your voluntary after-tax solo 401k contributions. We field questions every day, for example, educating customers in terms of how much they can contribute based on their situation, right? Based on their earned income, et cetera. Then once the funds clear into that voluntary after-tax solo 401k account, they can be transferred right away to a Roth account. So it could be transferred to a Roth solo 401k. Let's assume that you want to preserve the ability to take a 401k loan from those Roth solo 401k funds, or you think you might want to invest in alternative investments. Those are reasons why someone might want to transfer to a Roth solo 401k. Or let's assume that you're happy with your Roth IRA performance and you just want to accumulate more dollars in your Roth IRA. Well, that's where the $72,000 Fidelity Roth IRA hack comes into play. In which case you could just skip employee, skip employer, make 100% of your self-employment compensation up to $72,000 as a voluntary after-tax contribution. It goes into a separate voluntary after-tax account, and then it gets transferred over to your Fidelity Roth IRA. It could be your existing Roth IRA or a new Roth IRA. Now that subsequent transfer, that's going to be reportable. The first step, the contribution, that doesn't need to be reported. Doesn't need to be reported on the personal return or the business return. But the second step, when you move the funds from the voluntary after-tax solo 401k account over to the Roth solo 401k or the Roth IRA, in either case, it's got to be reported on a Form 1099-R. Now, my solo 401k financial, we handle that for our customers for no additional charge. Now, we don't have access to the accounts, so the clients or the advisors do have to let us know, but they can do it quickly and easily. Just go to mysolo401k.net/forms, submit the form. It just takes a minute. That's how we capture the information that we need to prepare that 1099-R. Now, as we talked about, there are deadlines to make the contribution, the first step. But the second step of transferring those voluntary after-tax solo 401k funds, there is no deadline to convert. So there's many folks, for example, who are still making after-tax contributions for 2025 in 2026. And then they'll convert the funds, of course, in 2026, because that's the second step. So that 1099-R that has to be issued is based on the year of the conversion. Even though the funds went in there as 2025 contributions, is not reported on the 2025 1099-R, it would be reported on the 2026 1099-R if the funds were moved to the Roth account in 2026. So then we generate that 1099-R. We would do it by the following February. We file it under the electronic filing system. We provide a copy to the customers, and they can share it with their tax advisor. So here's some good images as it shows an example of the holding accounts. So here's a one participant plan. They've got 3 accounts for their solo 401k XYZ Trust. One is for pre-tax contributions or rollovers. Another is for Roth solo 401k funds. And then a third is for voluntary after-tax solo 401k funds. Here's an example with 2 participants. Let's say it's a husband and wife that are both working in the same business, both participating in the same plan. In that case, they would have 6 holding accounts, pre-tax, Roth, and after-tax for each of them. Or let's assume the individual is not interested in transferring those after-tax funds to a Roth solo 401k, and they just want to transfer the funds out to a Roth IRA, such as a Roth IRA of Fidelity. They might just have 2 accounts, a pre-tax and an after-tax, or maybe even 1 account, just a voluntary after-tax. If they're not going to have pre-tax or Roth solo 401k funds in the plan, they don't need to open up separate accounts just to sit there empty. So then those funds can be deposited into the voluntary after-tax solo 401k account, then transferred out of the plan to the Roth IRA. Okay, wonderful. Thank you so much for checking out today's session. We're going to turn to some of the questions that have been chatted up. Thank you so much for bringing the questions. If this information is helping you feel more confident about your future, please take 1 second to like and subscribe. Liking tells the platform that the content is valuable, which helps others like you, other solopreneurs, other advisors, helps them find it. And that might be helpful to them as they try to secure their retirement. Subscribing guarantees you get notifications of all of our crucial content that we deliver every day to help you secure your retirement. Okay, first question from YouTube. How quickly can the conversion be done from voluntary after tax to Roth? So as we talked about, it can happen right away. There's no seasoning requirement. Most folks will transfer the funds shortly thereafter because they want to invest, right? They want to start accumulating gains that have that tax-free growth potential. So there's no deadline, but it can also happen right away. All right, next question is from Roth. Thanks for bringing the questions. How the tax owed is calculated for a Roth conversion. Also, is it possible to convert only a portion of the funds held in my solo 401k rather than the full balance? So if we're talking about voluntary after-tax solo 401k contributions that are being transferred either to a Roth solo 401k or a Roth IRA, there would only be a taxable portion if gains had accumulated in that voluntary after-tax account. So if there's no gains that accumulated, then it's just reportable. It's not taxable. Because remember, the source of those funds are voluntary after-tax contributions. So this is money that the individual earned as a self-employed individual and then contributed to the plan. But they're contributing it on an after-tax basis. So they're not taking a taxable distribution on their personal tax return or their business tax return for the contribution. So those funds have already been taxed. Only if there are gains that accumulate in the after-tax account, when those gains are transferred to the Roth account, do they become taxable. Now, as far as the transfer, it's going to make sense to transfer the full amount. Otherwise, you could end up in a situation where you've got a portion that's basis and a portion that's taxable, and it can become complicated to figure out, okay, which is which. So in addition, most folks will want to invest all of it right away so they can accumulate as much gains as possible. So if we're talking about a pre-tax to Roth in-plan conversion, that's when you're taking pre-tax dollars, so dollars that have not been taxed at all, right? The pre-tax contribution plus all the gains that accrued in the pre-tax account on a tax-deferred basis. So none of those funds have been taxed. So when those funds get moved to the Roth, they're going from a pre-tax account to a post-tax account. So the entire amount that's transferred to the Roth account from the pre-tax account is taxable. Now, our plan, of course, allows for in-plan pre-tax to Roth conversions. We also handle the reporting, right? The 1099-R for no additional charge. Customers, their advisors have to let us know. It's taxable for the year of the transfer. So whatever year that transfer occurs in, that's the year that it's taxable for. Now, of course, the client can transfer as much or as little as they want, but the entire amount will be taxable. Is it too early to fund fully after-tax contributions for both myself and my spouse? No, it's not. So there's nothing that would prevent the self-employed individual from making contributions now for 2026. A lot of times we talk about what's the deadline, but you don't have to necessarily wait until the last minute. Individuals can contribute now, right? And now you can start to get that potential for tax-free growth. You can start investing. The only word of caution is that you want to be certain that you'll have the earned self-employment income to justify the contribution so you don't end up in an excess contribution scenario. All right, thank you so much for the good questions. Let us know if there's any final questions here. We want to invite you as well to our community. We've got the largest community of solopreneurs, advisors, just interested parties around this topic, which means we've got vibrant forums. We have a library of videos and webinars. So there's a ton of ways to engage, a ton of ways to learn, a ton of ways to share the knowledge. And it's totally free to join. It's not just limited to clients or advisors. All are welcome. You can join quickly and easily at mysolo401k.net/my community. So please don't hesitate to join. Thank you so much for the great participation. All right, back to Roth. I have funds in my solo 401k and plan to invest in a startup LLC and a real estate LLC. Could you please advise what documents are required to make these investments? Any compliance restrictions to be aware of? And what reporting or tax filings are required and by whom? So the solo 401k can invest in alternative investments. Our plan does allow for that, but you've got to consider, of course, the prohibited transaction rules and just the general investment requirements. So in terms of the prohibited transaction rules, the solo 401k, it has to be a passive investment. So for example, the solo 401k owner, the solopreneur, cannot be on both sides of the table. An individual cannot use their solo 401k to invest in their own business or a business that that individual owns or works at, or a business that a closely related person owns or works at, like a spouse or a child. Number one. Number two, so that's your prohibited transaction test in a nutshell. Is this investment even allowed, right? Then you have to make sure that the investment is a passive investment. So the individual, yes, it's possible to invest in a startup. For example, individuals are investing in pre-IPO stock, or it could be just a closely held corporation of somebody that's in your network. But the investment has to be a passive investment. An individual cannot run a startup through their solo 401k, but they could passively invest in someone else's business. Now, that means, of course, that the solo 401k needs to be a minority owner, number one. The investment needs to be structured as an equity investment, or it could even be a loan to that startup. But the investment would need to be titled in the name of the solo 401k. So, for example, it would have to be titled under the name of the plan. You would have to give the EIN number of the plan to the investment provider because they may have to do tax reporting. They may have to issue a K1 to all the investors. That K1 will need to be issued to the EIN number of the 401k, which we obtain as part of our services for no additional charge. And if we're talking about a startup, meaning a business, then that could trigger unrelated business income tax issues. So unrelated business income tax issues apply when a solo 401k, essentially a tax shelter, invests as an equity investment in a business where that business itself is taxed as a pass-through. Now, under the S corp rules, you can't use your solo 401k funds to invest in the stock of an S corp. But let's assume that that business is taxed as a partnership, so it's taxed as a pass-through, and that underlying business is providing goods or services, so it's an active business. So under those UBIT rules, those unrelated business income tax rules, that income from the business that flows to the solo 401k through its partnership investment will be taxable by with the tax payable by the solo 401k. So that doesn't mean that it's prohibited, but it's going to impact the return in that investment because now the solo 401k is going to have to file a tax return, have to pay UBIT tax on that income. So that's an issue. Now, if that startup LLC, let's say it's a Delaware C corp, right? An equity investment in a C corp, though, is not subject to UBIT. So if it's a C corp, that UBIT issue doesn't apply. Real estate LLC, now this could vary, right? Because the underlying activity itself might be a passive investment. So solo 401k plans, our solo 401k plans, our solo 401k clients are investing in real estate. You still have to have that notion that it's a passive investment. It's not a prohibited transaction, so they're not buying or leasing real estate to a disqualified person like the solo 401k owner or the solo 401k owner's business or spouse, etc. But let's just say that they want to invest in real estate. Could be a single family rental, and they want to hold that real estate in an LLC. In that case, it would be a single member LLC where the sole member of the LLC is the solo 401k, and the property is then held in the name of the LLC. You still have to honor and follow all those rules that apply to real estate investing generally, right? Where, again, if there's no prohibited transaction, the investment is a pure passive investment. So the solo 401k owner, the solopreneur, cannot work on the property, cannot use the property for personal use. If there is debt involved, then it has to be non-recourse debt. So that means that the solo 401k owner, the solopreneur, cannot guarantee the mortgage. The lender, the lender's recourse would only be the property itself. So the lender would not have recourse against the solo 401k, even though the solo 401k might be the ultimate owner of the real estate. So there are companies that do provide non-recourse financing to people's retirement accounts, but because of those non-recourse rules, because their only recourse is the property itself, they're going to price that financing differently. So that means, for example, that they'll typically want 50% down, maybe shorter terms, higher interest rate. So it would be prudent for the solopreneur to really understand, of course, the terms of that financing, because it may not meet their expectations. Okay, great question. Thanks so much for bringing it, Roth. All right. Well, that looks like it's it for today's solo 401k session. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so we can keep building this solo 401k community. We'll be back here tomorrow with more crucial content to help you secure your retirement. Thanks so much.